Hello, welcome everyone. Thank you so much for joining us this afternoon. Both my co-host and friend here, Mike Ersser, and myself, Frank McLaughlin, we're so excited to be talking with you today and start getting into some smart tax strategies for this year, for 2024. We've got a lot to get into, so we'll go ahead and dive right in with our agenda. So really where we wanted to start today was a brief history of taxes in the US and what that history could potentially tell us about the future ahead. We then want to take a look at a very popular topic right now, the national debt and the US budget, and how that could potentially impact benefits like Medicare, Social Security, things that maybe have felt guaranteed in the past, and that may not be the case going forward. Point number four, we're going to look at tax efficiency in retirement. This may be my favorite point in the whole presentation. Mike is going to give us a great takeaway called the tax efficiency ladder, so stay tuned for that. We're going to take a look at a Roth conversion case study to look at, if done correctly, how powerful that can be and just ways that you can take control over how much to a certain extent and when you pay taxes. And then wrap things up. Make sure that we save time for questions at the end. But we also want to answer questions as we're going through this presentation. So there's a Q&A box, a question and answer box on your screen. Please send questions to us throughout, and we'll take periodic breaks to answer those for you. Let's go ahead and dive right in with some quick introductions. So here's a photo of my better two-thirds and the personal photo down here. This is my wife, Allie, and our golden retriever, Jet. And I've been at Merriman now going on over a decade. And really what got me into this role and so excited about my work every day goes back to my childhood. So I had parents who focused 110% of their energy, their value on their children. And what it meant was that they missed out on work opportunities. They missed out on retirement savings, on tax planning, all of these things that take so much time and effort to stay up on. And they're paying for it later in life. And to me, that just always felt so unfair that you could put family first, have these strong values and fundamentals, and yet be punished for not spending as much time on the investment side, which can be so complex. And so I'm so happy to be able to help folks not have to make that decision. I'll now pass it off to my host here. This is Mike Ersser.
Thank you, Frank. So yeah, here you're seeing obviously the professional shot, and then I as well have the family shot on the lower right. I've been with Merriman for coming up on 6 years. Absolutely love it. I think the biggest joy I get is helping folks navigate the puzzle that is retirement. And I like to give the example. It's each piece is relatively easy to understand, but the whole puzzle, putting it together, that's the hard part. And I think that's where we can definitely help our clients. Family picture there. You got my wife Alyssa. We got our oldest son Cameron in the red shirt. Got our middle child Jackson in the hat, hanging out with mom. And we're actually missing one. We have a new addition, Parker, who's about 3 months old. And so I need to get a new photo once we get some professional pictures taken. But yeah, family's a big part of my life, obviously. And I think a really cool part of my role is, we're helping folks navigate various items as they pop up. But I also get a ton of information back and guidance from my clients. And I think one thing that resonates with me is being present, right? My years are hard right now, young family, but clients over and over again say, hey, enjoy this time, because you're going to look back and you're going to want that screaming kid or that, midnight wake up. So it goes both ways. And I think that can be related to your guys' retirement plans, to be present, right? Take the time, even if it feels easier to put something off, maybe ignore it for that year, that quarter. It's worth it to take a look and maybe take action if there's an opportunity. So excited to be here. And yeah, we're going to jump into quite a few items today and hopefully answer some questions as they pop up. Thank you, Frank.
Yeah, such a great reminder. Thank you, Mike. And really, one thing I wanted to call out beforehand is today our focus is on tax strategies, tax planning, which is so important, really adds up over your lifetime. But you need to also remember that tax strategies and tactics don't work in a vacuum. And so as we're talking with a group, we may suggest something that sounds amazing, but you need to make sure that it fits with your own individual and family's situation before going out and implementing. As Mike alluded to with you putting together this puzzle, your tax planning can't come at the detriment of cash flow or investment planning. It needs to fit in place with any sort of estate planning that you've got set up, your wills, your trust, how things go on to kids and charities, certainly how it fits into your retirement picture, insurance. There's a lot of different moving parts. And so before running out and implementing anything today, just take a pause, make sure it works for your situation, ask us additional questions, and hopefully today brings some value for you. So real quickly here, before we get into a brief history of taxes in the US, it did just get an initial question that came through. So thank you for using that Q&A box. Keep using that throughout. We got a question here about potentially rising tax rates with sunsetting laws. Thank you for getting ahead. I don't know if you already saw our slide deck, but that is very important. If you hold on to that thought, yes, there's some big potential changes coming here in 2026. And in our conversation within the next hour, Mike and I are going to give you some strategies and some ideas to think about getting ahead of that and what it might mean. So thank you for that. We'll touch more on it. Keep the questions coming. And Mike, I'll pass it off to you.
Perfect. Thank you, Frank. And so a brief history of taxes. We thought best to really start with a question. And so give me 1 minute here. And there we go. All right, so question number 1. And this is something just to write it down, maybe just think about it. But what is the highest marginal tax rate in the history of our country? Is it A, 37%, B, 56%, C, 70%, or D, 94%? So take a minute. What does your gut say? Maybe jot that down. I'm going to reveal the answer here in just a minute. The answer is D, 94%. So if you look at the top of this graph, it's really in the 1944, 1945 timeline. And that's 94% was the highest marginal tax rate. And so taxes are important. And I think this paints the picture that we might be at a low tax rate looking at this graph relative to history or the last 100 years or so. There's 2 things in taxes, right? And we get this kind of question, this gets confused quite often. There's the marginal tax rate and the effective tax rate. So today I wanted to just take a couple minutes to go through those 2 so we could dispel that for anybody else that might not know the 2 or think they're the same thing. So first, we're going to start with the marginal tax rate. And so what you're looking at here is the 2024 federal tax tables. On the left-hand column, you have the various percentages ranging from 10% all the way down to 37%. And then you got MFJ, stands for married filing jointly. And then you have your single tax brackets on the right. So I'm going to focus on the married filing jointly for today's presentation. So one example, or kind of one way to look at this is, let's use a number, right? So let's say you have $133,500 of income in a given household and you're married filing jointly. What's your tax rate, right? So if you're looking through the MFJ column there, between $94,000 and $201,000 is where that number falls. So in this example, you are marginally in the 22% tax rate. Another way to look at that is your last dollar is in the 22% tax rate. So then that's not the tax that you're paying on everything, but that is the last dollar being taxed. So keep that in mind. Marginal rate is kind of where you land, kind of where do you end up in the last dollar that's subject to tax. So that's marginal tax rate. To kind of compare that to effective tax rate, we want to run through an example. And so here, you're looking at quite a few numbers on the screen, but we are keeping that same $133,500 income number in the lower left in the green color there. So now let's run this through the tax table that we just looked at. So the first number above that is $29,200. So that is taxed at 0%. There is no 0% tax rate, but that's in fact the standard deduction, right, for a married couple. And so the first $29,200, not taxed, avoids taxation. And then you dip into the 10% bracket. So we're going 1 box up. $23,200 is in that 10% bracket. So $23,200 times 10% equals the actual tax liability on the right of $2,320. And then we're just going to go up the chain here. So the next chunk, what fills the 12% tax bracket is $71,099. Creates an $8,500 tax bill on the right-hand column. And then the last $10,001 lands or ends in that 22% tax rate bracket, which has a tax bill of about $2,200. And so again, back to that last dollar landing in the 22% tax rate, tax bracket, that's your marginal tax rate, 22%. But if we go back to the right column here and start to add up each one of those liabilities going down the line, the total tax is about $13,000. And if you take the $13,000 number divided by the income number of $133,500, that's much closer to a 10% tax rate, which is your effective tax rate, right? What is your average tax rate that you're paying as different income amounts hit different tax brackets going through? So this is your effective tax rate, also known as average. So marginal, kind of your last dollar, where do you end up? Then effective is what are you actually paying relative to your income in a given year. So hopefully that helps with anyone that's wondered what those are or thought they're the same thing. It's a very common question we get once you kind of go through this exercise. Hopefully it's a little more palatable. We're going to jump in and grab another question. And so what do you think will happen to the high marginal tax rate in 2026 and beyond? And so a lot of people have varying opinions on this. Really only two answers here. I guess it could stay the same, but we're going to go with could go up or could go down. So just take a second, think about what your gut thinks on that. Taxes going up or going down, 2026 or beyond. And I'll give you a couple of hints as we're going through this. And so two famous economists, pretty well known, Peter Diamond and Emmanuel Saez, wrote a well-known paper well over a decade ago, really talking about a progressive tax system, which is what that marginal tax bracket was. Essentially, the more you earn, the more taxes you're going to pay as the tax rates increase. And that's the paper, really talking about high earnings coming up. And so we don't have the answer. This is kind of a trick question. I don't know which way tax rates are going to go. I don't think anyone really does until the legal system, in Congress and IRS kind of hammer that out. But just given the context of that graph, we are at relatively low tax rates compared to the last 100 years. And so, I'll leave that to you to decide on if it's up or if it's down. But they're going somewhere, most likely. I doubt they're staying the same. One element when you're thinking about taxation that we get questions on all the time and definitely help clients navigate strategy on is Social Security. So we want to take some time to really kind of walk through when was Social Security created? What's the point of it? What are some of the stats around it? So what you're seeing on the screen here is a table that really begins with the beginning of Social Security. So the program was established in 1935. Back then in 1940, when benefits were getting distributed, there's 159 participants for every one person drawing a benefit. So roughly 160 people paying into Social Security for every one person drawing a benefit. So keep that in mind because I'm going to give you a more recent value here shortly. Age to draw benefits was 65, with life expectancy 61. I'm going to say that part again. Age to draw 65, life expectancy 61. It's a backup plan. It was created for those who outlived, the life expectancy. So that in case, they needed more funds beyond a typical lifespan back then. But keep that in mind. We're gonna tap on that here and again in a second. A little bit of evolution of Social Security. Some of the major changes they've made back in the 1950s, added disability insurance benefits. Fast forward a little bit to the 1970s. There's a formula mistake that actually took 7 years to correct. So 1977, they finally got that corrected. And really the last major change was in 1983, back with President Ronald Reagan. And they were actually increasing the tax rates on Social Security to avoid insolvency, which I know is something that makes the headlines quite a bit lately. It might be on some of your minds as well. So let's fast forward a bit, right? More current day. How many workers contribute for each benefit? We're down to 3. It was 159 to 1. Now it's 3 to 1. Age to draw benefits is now 62. Average number of years that most folks draw is anywhere between 12 and 18 years. When are the outflows going to exceed inflows? We're here. We're living it. 2024 is kind of the breaking point on this. And right now, and it's probably fluctuating a little bit, but in 2034, Social Security is on pace to be exhausted unless there's some sort of change that takes place between now and then. So time is ticking on Social Security. We're not trying to scare anybody on this, but it's helpful to get just the information that is out there. And so quite a bit different landscape from 1940 until 2024. How do we get there, right? What's contributing to some of this? A big component is the retirement of the baby boomer generation. Those are born 1946 to 1964 are drawing benefits typically. And there's a big cohort, meaning a percent of the population in the baby boomer generation is larger than other cohorts, whether it's a millennial, a Gen Z, and what have you. Longer life expectancies, modern medicine, focus on wellness in the household, right? People are living longer. So that's also an extra draw, on the benefits system when you're taking the Social Security benefit as opposed to contributing. Lower earning power of the Social Security reserves. Outside of the last couple of years, which interest rates have been quite high, they've typically been pretty low. And so the Social Security reserve have not been earning enough to keep up with what the demand is going to be, from kind of this point forward. And of course, Congress unable to agree on anything. It's been a struggle in the past, maybe a struggle in the future, but that's also a hurdle that often takes time to navigate. And so I don't think anyone wants to step on, the grenade that is adjusting Social Security, because it's a hot button topic and that might swing a vote one way or the other. And so it's kind of a slow moving item when you're really looking at change in the Social Security landscape. One thing we want to call out, and many of you have probably looked this up or utilized some of this to determine your own strategy, is your Social Security statement, right? And so you go to ssa.gov, you can get a statement, whether it's something you're going to draw soon on, something you want to plan for in the future. We use this quite a bit with clients to make sure that we're mapping out what their expected benefit will or won't be, come retirement time. I think a big thing to notice on this is that it is purely an estimate, right? Changes in law could affect this, changes in structure, whether that's a retirement age or a drawing age. And so it is an estimate, but like most things, you run with, at least our opinion is, you run with the most current information you have and then adjust accordingly, if the landscape shifts on you. But yeah, just want to call out, it's an estimate. I think it's very accurate, as long as the current structure is in place, but hey, it could change like a lot of things. And so we're not trying to raise alarms on Social Security, but it's just information that I think is helpful when you look at retirement and kind of maybe what other resources you might want to count on if the landscape is to shift in the future. So before I turn it over to Frank, I want to check for a few questions here. I do have a good one. Okay, so I'm scaring a few people, looks like. What is going to happen to Social Security when it runs out? That I don't know. I don't know if Social Security is going to run out. I have a personal opinion that there will be somebody that steps in front and makes some sort of correction. And so a couple things that could happen, and this is something I've shared with clients quite often, is, right, maybe they increase the Social Security wage base to tax a higher amount of earnings to fund Social Security. So currently, up to $168,000, $169,000 of earnings, typical W-2 earnings, is taxed, meaning that money goes into Social Security. If you were to earn $1 million in a given year, the amount above $169,000 is not subject to Social Security tax. So they could open up the top on that and maybe allow more income to be taxed, and therefore there'd be more revenue for the Social Security system. They could increase the actual tax rate. Right now it's about 6.2%. They could ratchet that up, 7, 8, right? None of us are going to like that, but that is a tool in the tool belt, so to speak. And then I think the last one that might be relevant is they could push back full retirement age. For most folks, it's age 67 right now. 10 years from now, maybe it's 70, maybe it's 71, especially as folks are living longer. And so my personal thought on this is maybe there's some adjustments for next group of folks that are coming in. So if you're drawing Social Security and you're worried about it running out, right, we don't know what's going to happen, but my gut would say that they're going to change it for the folks that have not reached that point yet. Big reason why, it might not swing a vote, right? You got to think of the momentum of, if you change something now for people's current benefits, that might upset them, and they might vote a different direction. And so that's just my personal thought on that. But there's a lot of tools in their tool belt that they could utilize to make a change. And so great question, Rob. You're not the only one thinking that, and hopefully that brings a little peace of mind on some avenues that they might adjust. So Frank, I'm gonna turn it over to you for national debt and the U.S. budget.
Perfect. Thank you, Mike. And I appreciate you starting to talk about some of the levers, the tools in the tool belt. I'm going to elaborate a little bit more on that piece, but this is really a hot button topic, just seeing these very large growing numbers when looking at the national debt, and get a lot of questions, especially from folks either close to retirement or in retirement, on what that could mean for them. And so I'd like to take a step back for just a moment, and an analogy that I like to use when talking about a budget or looking at a budget is a pie. And the reason I use that is no matter how you cut a pie, no matter how you slice and dice it, there's only a set amount to go around at the end of the day. You can't make something out of nothing. And so, with that kind of picture in our minds right now, how the US budget is currently broken down or projected over a pie, if you will, there's these three main categories up top. So, Social Security, healthcare, and retirement programs, plus the interest being paid on the national debt that take up over three-quarters of the budget, about 78% of that pie. And standalone may not mean much, but when we look at all of the other areas fighting for that last slice, we've got military spending, education spending, foreign aid, environmental protection. And no matter how each of us personally feels that that budget or our tax dollars should be spent, I think we can all agree that it's not sustainable for all of these other important categories, areas to have to fight for just a sliver of that pie. And this has led to this trend going back the past 50 years. We look at, the bars that go below zero are years that we ran a deficit or spent more than the allotted budget. And we can see just a very small number of years that we were actually in a surplus, or didn't spend as much as our budget allotted for. And so what this has led to is these questions that we've started to talk about today, with the debt, with potentially rising interest rates impacting that debt. What is going to be there for retirees in the future? And not to paint something that's too dire, but if nothing were to change, Mike and I will often get questions of, is there going to be anything left? Will it just be crumbs? Well, building on Mike's point earlier, before we say there's only going to be crumbs, what sort of options, what other tools are available to Congress to make these changes? Well, the first one, make more money. That involves increasing taxes. The second, number two, spend less money, which involves further cutting spending to these various programs in need. And neither of these are very popular. If it's difficult enough to get normal kind of bipartisan things through Congress, the idea of cutting spending and the idea of raising taxes, neither of those sit well with people, which has led to Congress turning to option number three, or additional credit. And so, as we see just here, just the national debt has steadily grown over time. The latest number that I saw was about 35 trillion. And the interesting thing there is really just as interest rates also have, gone up, hopefully going down here soon, but gone up since 2019 timeframe, that is putting more and more pressure on that budget. We already saw that the interest made up a good piece of that pie. So with rates being higher, puts more pressure there, which leads to things to prepare for. And neither Mike, myself, our team, we don't believe that Social Security is going to go away. Don't want to suggest that. But as Mike alluded to, it's not difficult to imagine full retirement age to claim your full benefit being pushed back a few years, or benefits potentially being reduced a little bit. Same with Medicare. We don't have any crystal ball that suggests Medicare is going anywhere, but it's not difficult to imagine premiums or the monthly cost that you pay as part of Medicare going up, or potentially benefits being reduced. We've already talked a few times now about the other lever of potentially tax rates going higher, getting more in line with historical averages after that chart we got to see earlier. Really, our intention with this slide isn't to scare you. It's more to say now is a wonderful time to have an intentional plan in place so that your retirement will be safe no matter what changes come your way that are out of your control. It may not play out. It may not be the same retirement that your parents, grandparents had when everyone had pensions and Social Security was more plentiful. And so now is really the time to take control when looking at your investments, saving if still possible, but also tax strategies that you can implement to hopefully reduce taxes over your lifetime and have more to spend. And so before we get to, as I said, my favorite point here, the tax efficiency in retirement with some great takeaways, did just want to take a quick moment to look at our Q&A box, look at our questions that have come through, and we have a great one here. So thank you, Sarah, and I'm kind of just paraphrasing, but asking about what's called IRMA, or how does income affect Medicare surcharges, Medicare premiums? That's a wonderful question, and it's often misunderstood or not even known before folks turn 64, 65 and start thinking about Medicare. But your income is going to impact how much you have to pay. It will impact your Medicare premiums, the cost to you. And something that's very interesting here is they've got a 2-year look back period. And so let's say I turned 63 this year in 2024. My income this year is going to impact the cost of Medicare for me 2 years down the road. So when I turn 65. And so even if you aren't on Medicare yet, it's important to start doing that planning now and really decide, if you can, if it makes sense to raise, makes sense to lower, what you can do to control your income, because that will impact monthly costs, monthly expenses that you have 2 years from now down the line. So a lot more there to uncover. We did just want to start the discussion today. So thank you. Keep the questions coming. And on that note, Mike, I'll pass it back to you.
Thank you, Frank. Great picture here. I'm an avid fisherman myself, so I'll take a minute just to take a beauty in the boat out there on what looks like the Puget Sound. I know the coho salmon are running right now, so if anyone's a fisherman or fisherwoman out there, it's a great activity if you can get out there. That's not why we're here. We're here for the tax efficiency ladder, and talking tax efficiency in retirement. And so we wanted to introduce a concept called the tax efficiency ladder. And so we're going to break it down into really 3 parts. So the first part is the lowest level, right? Maybe the least tax efficient account. And there's a space for all these accounts, so keep that in mind. But when we're talking efficiency, we have the lowest level being a taxable account, or known as a brokerage account. Maybe it's an individual account or a joint account, but a taxable account. So maybe a non-retirement account is another term for it. It's funded with generally after-tax funds, meaning you get a paycheck, you take that money and then put it into an account like this. While the money's in that account, assuming it's invested, you are taxed on the holdings, right? In terms of the dividends or the interest that might come off of some of the holdings inside. So you get a tax bill throughout the year. And then if you sell items in there, assuming it's at a gain, you face another tax level being capital gains. Short term, which are at your marginal rate. So going back to that table we started with, and that's generally for position held less than a year, or long-term capital gains, which are for positions held more than a year. And that's at a whole different tax table, definitely more favorable than that marginal tax rate. We're not going to show it today, but long-term gains are taxed at a lower rate than short-term gains. But still, tax money then goes in, your money gets taxed, it goes in, it's taxed while it's in there, certain elements are, and then it's taxed if there's a gain on the way out. So lowest level, taxable accounts. We shift to the middle level, now we're thinking retirement style accounts, tax deferred accounts. 401k is probably the most well-known option there. IRA would be another one. So you do get a tax break, if we stick with the 401k, you do get a tax break on funds going in, right? So that's up a level, middle level. The funds in that account, right, the dividends and the interest is tax deferred, meaning you don't get taxed on the holdings that are inside of that account throughout a given year. Where does the tax come for you? Upon distribution. And an easy example of that is you take out $10,000, you pay $10,000, or sorry, you add $10,000 to your income for the year that wouldn't be subject to the tax tables that we started with. And so middle level, because you do get some tax breaks and they get you on the way out. So taxed upon distribution. And why I think we're all here is, the highest level. What is the better accounts, tax-free accounts, which I'm going to give two examples. Roth IRA is the big one. That's what we're going to talk about most today. But there's also something called an HSA, which is a health savings account, which is tax-free for distributions for medical expenses. So just want to call that out because it's a really great tool, especially folks who are accumulating. It's a really powerful account to save into. But we'll stick with the Roth IRA from here on out, outside of some contribution levels. But highest tax level account being the tax-free accounts. Think Roth IRA. So how do we climb this ladder, right? Bottom to the top. One way is contributions. The other is conversions, which we'll get to. So if we're sticking with contributions, right, that's money going into it kind of on the front end. A good way to look at this is going from the bottom to the top, right? You have your money in your bank account or your non-retirement account, and you can just put it into the Roth IRA in this example. And so think of your paycheck money coming from your paycheck, hits your bank account, going to the Roth IRA. On the contribution side of things, there are limits, right? You can't just put $50,000 into a Roth IRA in one given year. So if we start on the left, health savings account is what HSA stands for. So I just wanted to mention, some contribution limits in case those are interested. If you have a self-only plan, it's $4,150, meaning you have a high deductible healthcare plan that allows you to contribute to a HSA. You could put in about $4,200. If you have both spouses in this example, if you're married and have both spouses under the same plan, meaning like husband and wife or partner in the same plan, maybe both are on one employer plan, high deductible healthcare plan, you could put in $8,300 into one. If you have different plans, right, husband, wife, or partner, and you each have different healthcare plans with your employer, then you got to go back to the $4,150 each. And so that gets confused quite a bit, but I wanted to clarify that a little bit. And then for those that are age 55 plus, you get an extra $1,000 on top of each of those in the respective areas. And so health savings account, a great tool in the tool belt for sure. And if we look at the Roth IRA, which is really the rest of this efficiency ladder, it's $7,000 a year. For those over the age of 50, tack on another $1,000 to call it $8,000. And so you can't put in 50 in a given year, but if you're in the right area, you can put in 7, maybe $8,000 if you're over the age of 50. There are some limitations, which trips up quite a few people. And so I want to talk through the AGI limits, or the adjusted gross income limits. And so you're looking at the single phase out of the top line, and then we're going to focus on the married filing jointly phase out on the bottom. So that $230,000 to $240,000 range. And so if you earn a lot of income in your household, say, for example, more than $240,000, you cannot make a Roth IRA contribution directly. Because in the eyes of the government, you make too much money, so you're phased out. If you were to make somewhere in between those, and this is where you get some math going, if you make say $235,000, for example, you're right in the middle of that phase out, and so you'd be able to do half a contribution, meaning $3,500 if you're under the age of 50. And so anything less than $230,000, you could go back to make that full contribution of $7,000 or $8,000 if you're over the age of 50. And so a lot of people get tripped up on that, or you are making Roth contributions throughout the year. Maybe you get a bonus that kind of messes up your plan at the end. There are ways to back out contributions, so that's not a permanent issue, but you would want to address that if that's in your situation. And one thing we're not going to get into today, but it's relevant, is for those who make too much money in the eyes of the government to make front door Roth contributions, there is a concept called a backdoor Roth contribution. There's a lot more hoops to jump through, so we're not going to get into that today, but there is an avenue to continue to make Roth contributions through what they call the back door. So just keep that in mind. Reach out to one of us if you have any questions. I know Frank and I help quite a few people navigate that situation. Rules for tax-free distributions, right? It's all about the fine print. You definitely want to make sure you're following the rules to be able to utilize this highest level of the tax efficiency ladder. And the rule number one to make a tax-free withdrawal is being over the age of 59 and a half. And so this is actually only for earnings on your Roth contributions, right? So you can always take out the principal under the age of 59 and a half, and you're not going to face tax or penalty. We're really talking on earnings. But in general, 59 and a half or older is kind of the benchmark to get to to have the tax-free distributions, not have to do too much thought about it. The second rule, and this messes up a lot of folks too, is the account must be funded for 5 years to qualify for that tax-free withdrawal. So I'm going to walk through a couple examples to kind of spell that out visually, and I'll talk through it because it's very dependent on a few situations. So I'm going to come back to this one here in just a second. I said 2 ways, right? We started with contributions. Now we're going to talk conversions, which is generally more for folks in retirement, but not always the case. So same concept, right? We're going from the lowest level to the highest. And I think one way to look at this is a Roth conversion visually, or like in theory, looks like this picture here. Coming out of the tax-deferred account, back down to the lowest level, and then pumped back up to the highest level into the tax-free account. That's kind of the path that a conversion takes. In reality, it goes straight from the middle level to the highest level, and you pay tax on the amount that you convert. But in theory, that's kind of a good visual. Goes down to the bottom, wraps back up to the top. So a conversion, moving money from a tax-deferred account to a tax-free account, really thinking IRA to Roth IRA in this example. So it always comes down to more rules, of course. Back to reading the fine print and doing the math. Really, conversions aren't right for everybody. And the main reason or the main situation that a conversion would be attractive or worth pursuing or talking to one of us or another professional about is if the tax rate you pay, and I'm talking marginal tax rate, on the conversion is lower at the time of the conversion relative to what you expect your future tax rate to be in the future. And so the theme of this presentation, right, is potentially rising taxes. And so if you're at a tax rate now that will then be something higher in the future, you believe it will, considering Roth conversions could be an avenue to pay less tax over your life. You might pay more tax in that one given year, but that's not the point, right? That's one puzzle piece. We want to talk about the whole puzzle of paying less tax over your lifetime. And in fact, sometimes it's over more than one lifetime if you're talking about generational planning, right? Maybe your tax rate now is higher than it's going to be in the future, but lower than your kid's tax rate, if they were to inherit an account. That could be another avenue to pursue Roth conversions. And we definitely help people navigate that to keep the most money in the bloodline, so to speak. Then second rule, you want to get your 5-year clock ticking. So I hinted to that earlier. I'm going to walk us through an example of why that is important and maybe something that you don't know about. And so we're going to use this timeline here, and let's pretend you funded a Roth IRA for $10 back, or on end of this year. So 12/25/2024, very end of the year, you open a Roth IRA and put $10 in. The rules state that because it was in the year, you get to backdate that all the way to the very first of that year. So even though it was 12/25/2024, it's counted as January 1st, 2024. So you get that full year of 2024 counting as your 5-year clock. So continuing on with the example, say you want to do a Roth conversion for $100,000, right? You talk to your advisor, it makes sense for your tax situation or maybe generationally, and you want to make a big move. Shift $100,000 from an IRA to a Roth IRA, and you want to do that in 2028. If you start that 5-year clock in that example, right? So the clock started in 2024, you have your 5 years by the time 2029 rolls around, you can take out the earnings, income tax and penalty free. Income tax free because you're over the age of 59 and a half, and penalty free because you funded the account back in 2024 and have met your 5-year clock. And so anything from 2029 and beyond would potentially be penalty free. And the penalty only applies to earnings, right? So I said it earlier, but you can always take out your contributions, money you put in, both tax and penalty free. We're really talking about earnings in this example. So that's important to start the 5-year clock. I'm going to walk through what happens if you don't. So sticking with the same $100,000 converted in 2028, but maybe that's the first time you open a Roth IRA, right? And then you want to take out money in 2029. You could face a penalty, right? And so even if you're over the age of 59 and a half, that means you're not going to have the income tax tax on it because you're already 59 and a half. But because the account was funded in 2028, it has not been 5 years, right? You technically need to wait till 2033 to pull out any earnings penalty free. So you just want to be careful on that. A lot of people get a little mixed up. And the kicker to this is each conversion has its own 5-year clock. So it can get pretty technical if you're doing a lot of conversions. In general, when we help clients do this, typically they're not tapping back into that Roth right away. Maybe it's an account that you're saving for some navigation later in life. Maybe it's something that you want to pass on to your kids, given the inherited IRA rules. But yeah, it's very kind of technical when you get into the Roth conversions. And I think talking through it with one of us is helpful. So if there's questions on this, we're more than happy to kind of talk through in your scenario. I know Frank and I deal with this quite a bit, and kind of explaining the rules on this is helpful. At least you know, and then you can make any decision that's right for you. So before I turn it over to Frank to go through a conversion study, which I think is what a lot of folks are here to kind of get that preview on it, we're going to touch base and see if there's another question on this. And I've got one good one. So better to convert before or after retirement? I'm gonna give you the favorite answer, which is probably not everyone's favorite answer. It depends, right? It really depends on your situation. And it kind of goes back to what I just shared about if you're considering a conversion and your tax rate is lower now than you think it's going to be in the future, that is the reason to make a Roth conversion, not necessarily are you retired or are you not retired. And I think a good example of that is, say you did a $100,000 conversion at, say 22%, and you're going to be at 25% in the future. Your savings on that is 3% times the $100,000, right? The $100,000 coming at 22% now versus that same $100,000 coming out later at a higher tax rate. That's the upside on this. So it's generally not make or break. Is your money going to outlive you or not? Roth conversions generally don't make or break that decision, but it is definitely an efficiency. And I think one of the things that we definitely help clients at least consider, and for a variety of reasons that may not make sense, but it's definitely worth exploring. And it's a puzzle, and we like solving them. But Frank, I'm gonna toss it back over to you for going through the Roth conversion case study.
Perfect. Thank you, Mike. I absolutely love talking about Roth conversions, so I'm happy that we get to have some time for this in today's presentation. And so wanted to talk you through a specific example. And we removed the actual names, of course, and photos, but this is one that both Mike and I worked on. And so today we'll introduce you to, this is Bonnie and Bob. They live in their home, no mortgage, completely paid off, which was a big goal of theirs. Very happy to see that. They've got grown children, and now as they're thinking through retirement, how their Social Security, their investments come into play, as well as their cost of living, how can they do that in the best way possible? And the main goals that they shared with us, and kind of the starting point that we like to get into with everyone, is they want to live a comfortable lifestyle in retirement, which requires a certain paycheck, if you will, a retirement paycheck, either coming from sources like Social Security or strategic monthly pulls from investments that you've been saving, that you've been growing. Number two, they want to optimize their tax bill in retirement. They want to, of course, legally, but pay the least amount possible to Uncle Sam in order to maximize what they get to keep in their pockets to preserve that net worth for their kids and their grandkids. And so what we wanted to do with Bonnie and Bob was to see, okay, without you, of course, needing to go back to work or any lifestyle changes, how might Roth conversions be able to help your retirement, maybe give you a little bit more spending money, make things more efficient, like Mike called out. No need to memorize all of the numbers here and their asset statement, but one thing that got us so excited to see was, even though their Roth IRAs are relatively smaller compared to their other assets, the great thing was that both Bonnie and Bob understood that 5-year clock that needs to be started. And so they took care of that, even with some smaller contributions and conversions, just to give themselves a lot more flexibility later on. The main pieces here that they wanted to touch on was, for that comfortable lifestyle, they want to spend about $11,000 per month and have that go up over time with inflation. So one thing that we do in our goal planning amongst our team and software that we have is, okay, with 1,000 different potential scenarios of investment returns throughout retirement, how can we run those scenarios to give the highest probability of success, or the lowest need to make changes in retirement? So with everything that they had in place, their hard-earned nest egg, Social Security that they have, if no changes happen in terms of tax rates going forward, running those 1,000 scenarios, it came back with an 81% probability of success, which we feel very strongly about. Really, what we want to do is not 100% eliminate uncertainty, because that would mean likely ending up with much more money at the end of their lives than they wanted to and not fully enjoying money, but really above 70%, especially as life changes, is where we want to see this Monte Carlo report. And so just in their base facts, if no tax rates, no other big life changes happen, their plan is successful, which is great. Going back to the questions that Mike especially had asked earlier around what do we think is going to happen to tax rates, although we didn't say them out loud, we did want to stress test if rates go up in the future, what happens to that retirement plan? And again, we'll put this up here, but with that 81% probability, if tax rates go up, do we think their probability increases or gets better? No, I imagine that a lot of us would choose B here, that it will decrease. And so actually we modeled that out. And if marginal tax rates go up by 10% over the next 8 years, which in theory could happen, all of a sudden Bonnie and Bob's retirement is feeling a lot more uncomfortable, a lot more uncertain, and they may need to make some changes along the way, which could involve cutting back gifting to the kids and grandkids, maybe looking at somewhere else to live. They didn't want to entertain a part-time job, but that would be another possibility. And so what we wanted to do was, what if we introduce Roth conversions as a way to intentionally take control over when you pay taxes and, to a certain degree, how much, to avoid them having to make these changes. And so going back to just the base scenario, no tax rate increases, but utilizing Roth conversions, it bumped up the probability, which is great. More money over your lifetime is always a good thing, but the main benefit came from that stress test, where in our base scenario, it had dropped Bonnie and Bob to a level that we weren't comfortable with. By utilizing Roth conversions, their plan is in good shape either way. So I know a lot of information there. Kind of these types of reports may be new to you, but I did just want to highlight that they can be powerful in terms of being proactive and getting ahead of things. Another piece to remember, besides just Congress potentially raising tax rates for everyone, is your own income situation may change and tax rates may go up. Not to forget that at age 73, for some people, could be a little bit earlier, for others could be 75, really depends on when you were born, but at some point there's required minimum distributions. So think about your traditional retirement accounts, IRA, your 401k, 403b. What's great is you get a tax break in that given year, but at some point you've got to pay that back. And the IRS certainly wants their tax bill, and so there's required amounts that when you hit a certain age in your early 70s, they're going forward, you have to take certain withdrawals from those accounts and pay taxes along the way. And so even if rates didn't change, you all of a sudden may be in a position where you're forced to take out additional income, and that may bump you into a higher marginal tax bracket and potentially effective tax rate, like Mike showed us earlier. So don't forget your own personal situation in the mix here. Real quickly, going back to Bonnie and Bob, I know we had shown the probability of success, but what does that actually mean in terms of hard-earned dollars? And so in that base scenario with no tax increase in the future, Roth conversions saved Bonnie and Bob from paying an additional $140,000, $150,000 over their lifetime. I know that's a lot of extra trips to Disneyland, maybe to Hawaii with the grandkids, a lot of different things that you could do with that extra wealth. And then in the stress test with the tax increase coming down the road, by strategically doing smaller Roth conversions now, it saved Bonnie and Bob over $500,000 in taxes that they'd have to pay throughout their lifetime, throughout retirement, which just, I mean, just the power of doing this and, being careful, doing it over time, very intentional with the dollar amount. Like Mike was pointing out, you have to be very careful with the tax rates. But if you can get ahead of this, start doing this now, especially if you're able to do it before required distributions kick in, it can have a really big impact on how your retirement looks. So looking at another slide here and another benefit when thinking through Roth conversions, we're not going to get too in depth about estate planning or passing wealth on to your heirs, but Roth conversions do add another benefit there. So for most non-spouses now, if they inherit a traditional retirement account, let's say a traditional IRA, a lot of folks now will have 10 years to completely draw down that account, get everything out of that account within those 10 years. Now, they may or may not have a required distribution each year, but certainly for all of them, everything has to be out by the end of year 10. And if someone's inheriting this, maybe they're in their prime working years, they could be in a very high tax bracket and then receive a lot less than maybe you were hoping to leave for them. And so if it's also important for you to have control or maybe maximize how much you leave behind to your heirs, exploring Roth conversions now could be another potential benefit. And so when we look at, let's say you did Roth conversions during your lifetime, and then instead of passing on a traditional IRA to kids, to a non-spouse, you pass on what becomes an inherited Roth IRA. Well, that 10-year rule still applies, but everything that they're pulling out of that account is all tax-free. That even means, let's say they maximize that 10-year window that they have the investments growing. That could be an extra 10 years of growth. All of that, the heir gets to pull out tax-free, which just makes your gift, if that's important to you, go so much further. So just another element to think through there. Now the big question, is a Roth conversion right for you? I know in Bonnie and Bob's situation, it looked great, but you really need to take the time, look at your own situation, your own kind of projections for years ahead to see if it makes sense. I know, both Mike and myself would love to talk to you further about that, maybe on a one-on-one basis to give you some clarity there, but just some things you can think about today. Taxes are the main piece. Do you think that in the future, you're likely to be in a higher or lower tax bracket? Thinking through changes that Congress might make, but also your own personal income situation. Time. If you don't have a Roth account at this point and there's funds in that IRA that you think you might need to spend within the next 5 years, well, with that portion, maybe it doesn't make sense to do a conversion. That's something else to think through there. A bonus item that really adds a lot of value to a Roth conversion is if you can pay the tax bill from a non-retirement account. So what does that mean there? So when you do a Roth conversion, you are intentionally receiving that income as you put it into the Roth and you pay the tax that given year. Well, if you really want to maximize the amount that you put into the Roth, you can pay that tax bill from, thinking back to that tax efficiency ladder that Mike pointed out for us, could pay that tax bill from something lower on the tax rung, maybe a brokerage account, checking or savings account to get as much as possible into your Roth. And if you only have retirement accounts, nothing wrong with that, but it certainly will impact the value of doing Roth conversions for you. And so all of that is to say is, don't run out and try this at home right now if you haven't, thought through this process before. Really Roth conversions specifically, but taxes, investments, all the pieces of that puzzle that we looked at earlier, even if things feel straightforward, your situation is likely more complex than you realize. I hope that our educational session today started to give you some ideas, started to get the wheels turning on things to take advantage of to really set yourself up well for retirement, whatever that may look like. But also remember, you don't have to solve this puzzle alone. This is why advisors like Mike, myself, our team here at Merriman are so passionate about education, is to help you get ready for this, no matter what happens that's out of your control in the future. And so we're getting to the end of our time here. We will have another minute or two to answer any questions that have come through along the way in the Q&A box down below. One thing that I went ahead and did was in the chat box down below, I went ahead and popped our calendar link. A lot of the questions today are kind of, well, it depends on your situation. It depends on your goals, on your income. And in a group format, that's how it has to be. But we'd love to, just as a thank you for everyone attending today, to be able to answer some more individualized questions in a one-on-one conversation. So if that's interesting to you, you can click that calendar link and schedule some time with Mike and I, and we look forward to that. I'll also put our email addresses up here on the screen, and then open it up, see if we've got one or two questions that we can answer before our hour's up here.
Frank, I'm gonna jump in. We got one, I think, back when you're talking through Bonnie and Bob. Somebody must have liked the forecasting and asked, do we make 5 or 10 year conversion plans, for clients? And yeah, absolutely we do, right? I think mapping out the road ahead is something that it's not that easy, but it's fun and kind of gives you a preview. That's not the be all end all, right? Because the tax laws could change, your income could spike or drop in a given year. And so it's something that it's helpful to make a 5 to 10 year plan, but Roth conversions especially is a year to year situation. This year, what is my marginal tax rate and does it make sense? And then rinsing and repeat. And as we all know, life shifts quite a bit from year to year. So it's not a set and forget approach where you can just do, hey, 20,000 a year. And that's what I did 6 years ago. So I'm going to keep doing it. Because there are things that could impact that, right? IRMA is something Frank mentioned, income-related Medicare adjustment amount. That could add extra premiums to Medicare. You'd want to consider that component on top of the actual marginal tax rate if you're thinking about converting, and that's the real tax bill, right? So you don't want to miss out on that because you might be converting at a higher rate than what you're going to be in the future, and that would not make sense. And so, yes, we do make 5 to 10 year plans, but that's kind of framework, and it's really hand-to-hand combat going year to year, making sure it's still the right move for each person. So great question. And yes, and is the answer to that one.
Another question that we had here, it's kind of around timeline for completing Roth conversions. This is a tricky one. I'm so glad that you bring this up, because if you've been used to contributing to retirement accounts, to an IRA, let's say, over time, usually you've got a little bit of extra time into the following year, kind of before you file your taxes, where you could still have that count toward the previous year. That's with contributions. With conversions, it needs to be done in the calendar year. So if I want to do a conversion in 2024, it actually needs to happen this year. I don't get until January, February, March before I complete my tax return. So very important timeline there. And often it can take a little bit just processing at whichever custodian or wherever your account is. And so oftentimes when Mike and I are looking at this for clients, we're thinking through it much earlier in the year, but especially trying to get it done maybe in the October, November timeframe to make sure that you can count that and not lose a year of potentially doing another conversion.
I'm going to add one piece to that because you bring up a really good awareness item. And for those that are thinking about doing conversions that are in RMD mode, that required minimum distribution time period, you do have to satisfy your required minimum distribution first and then do a conversion. So you wouldn't want to do a conversion in January and then take your planned RMD in October or something. You want to flip the order around, or at least come up with a plan to satisfy that RMD prior to making the conversion. So you can avoid that speed bump, hopefully hearing that today.
So true. And it's not to open can of worms here, but we did have some questions, some thoughts on folks not necessarily being happy about having to take RMDs, and what can you do to avoid that? Well, if you haven't reached that age yet, if conversions make sense, remember there's no RMDs with Roth accounts, And so that could be one way to reduce or minimize that. Really, if you're at RMD age, the only true way to avoid taking them is you can donate that amount. And so, it's still money leaving your account. You do get to avoid the tax bill in theory, but it still must come out and go somewhere. And if you're charitably inclined, that can be great. But truly, it's getting ahead of age 72, age 73, and having that 5-10 year plan beforehand to get ahead of it. I think that brings us right to our time here. We very appreciative of you spending an hour here with us. We hope to continue the conversation, answer questions that we weren't able to today, and you can do that with the calendar link in the chat box. And we hope to see you again soon.
Thanks,
everybody.